All right, so we're going to go ahead and record this now, and we're going to be talking today about Virginia Housing and Development Authority and the loans that they have out there. These are phenomenal loans to buy as a first-time home buyer. This is actually a very similar loan to what I used when I bought my first house. They work great because even though you may not necessarily have a lot of money to put down on a house, they're actually very good because you don't have to use a lot of money to put it down. The only thing you have to really cover is your closing costs. Now, there are certain requirements in here that we're going to talk about to make sure everybody knows what's going on. But in essence, we're going to, this is a phenomenal loan for the first-time home buyer, and certainly a loan of choice that we want to present to the first-time home buyer. So today, what we're going to do is we're going to go through the basics of this loan. We're going to talk in general terms and introduce Virginia Housing. We're going to talk about eligibility, price limits, grant programs, other government programs that they have. They do have a couple different conventional programs that they work with that are very nice to work with. We're going to talk about the MCC credit certificate, the difference between target areas and non-targeted areas, and then what that means to you and to your buyer. And then also talk about the recapture tax and credit guidelines, as well as property guidelines. This is a phenomenal loan. I can't say this enough. It's a phenomenal loan for the first-time home buyer. It really does help them in most situations where they're very tight on cash. Now, Virginia Housing was created to help people with affordable housing. It is a not-for-profit entity, so it was created by the Commonwealth of Virginia, and to help first-time home buyers and organize themselves and also establish the home. It's phenomenal for anything from apartment communities and neighborhoods to revitalization efforts and all sorts of things like that. It has tremendous education programs and models to be able to help. In fact, if you decide to do teaching of the first-time homebuyer class, which is not a bad idea to do, they have a website where they can guide people to this to be able to help you gather more people for this class. And in this neighborhood, especially being where we're in this apartment, townhome, condo situation, I would imagine that this would be a great place to try to reach out on a monthly basis or quarterly basis to see if you do some of these first-time homebuyer loans. What happens many times when you do these first-time homebuyer classes is a lot of the people come trying to get oriented to how they're going to buy a house. They've never bought a house, and what they find is after they're done going through this process, I dealt with somebody just this last week. They're like, I don't think I can make it. I just don't think I have the funds. I don't think I'm ready. Well, after I sat down with this person and went through about a 45-minute meeting, they actually realized that they were further along than they thought, and that they could actually buy by year end if they really wanted to do this. And so this is a great program to help people with that. It's really designed for low to moderate income buyers. And so here's what that means. When you're getting down payment assistance, or you're getting a grant, or you're getting anything like that out in the marketplace, they really do require that you have a that you're not so loaded with cash and income that you're taking advantage of something that is not necessarily designed for you. If you have 20% or 10% to put down, you're not the right buyer for this. In fact, one of their requirements is that if you have a savings equal to half of the purchase price of the home, you're not qualified for this. You have to actually go with a different type of loan. Okay. And so you have to kind of go through the aspects of this, and you kind of have to go through the pieces. This is we've talked about overlays before. This is a loan that has a tremendous amount of overlays. It has a tremendous amount of stuff that we have to go through to make sure that this borrower is successful. And it really is designed for low to moderate income. Now, the way we have to calculate income on these is different depending on whether it's a grant or whether it is a down payment assistance loan, depending on which one they go for. The down payment assistance loan, in essence, 100% financing. That down payment assistance loan is less restrictive than if they're actually going to be handing money to you that you don't ever have to repay back to help you buy this house. Okay. The restrictive qualities of the grant tend to be much tighter than the restrictive qualities of the down payment assistance loan. So for general eligibility on this, what you're going to be seeing is that applicants to meet this standard, they have to be first-time home buyers. They do not serve second-time home buyers. Okay, it is specifically and strictly just first-time home buyers. Now, I say that, but there are areas that they're trying to revitalize, and so those are called targeted areas. If you're buying a home in a targeted area, you no longer have to be a first-time home buyer in order to get this type of financing. Now, those targeted areas are very, very, very tiny. There's not a whole lot of them in this area. But if you're going into one of these situations and the person who's selling their home is just barely getting out with the home that they're in, it's worth checking their website to find out if this home is located in a targeted area. Because if it isn't a targeted area, they may not necessarily make any money on the sale of the home, but it may not necessarily be an issue for them to buy the next house if it's in that targeted area.
Can you give us examples of any targeted areas around here?
Like Manchester, down the Jefferson Davis corridor. Okay. Some of those areas down in there are considered to be targeted areas. And so you'd have to look at it because it is neighborhood specific.
Sure.
But I'm going to tell you that if you do have a second-time home buyer who's looking to buy in one of those areas, you're going to find that this loan will work very well for them. Okay. They do have a maximum income and net worth and sales price limits. That's actually the very next slide. I'm going to show you that, but this slide I think is a little old. It is old, so I'm going to actually go to the website and show it to you here in a second. There are maximum incomes and net worth, and they have to take the VHDA homeownership education class. Now, this is where they get teachers from the community. I was a certified teacher for a long time. I taught the class for 8 years. It's a great way to help out in the community. Some people use it as lead generation classes. Now, in my case, I didn't use it as a lead generation. I just used it as a way to get back to the community. But you can use it for lead generation, but you can't. Okay, so here's what that means. Is when you have to go and get certified by Virginia Housing if you want to be a Virginia Housing trainer. Okay, what that means is that when you have the class, it is strictly for educational purposes. It doesn't mean that you can't have them call you after the fact, but you can't get a roster and call them. Okay, so that's where it kind of gets a little difficult with that, because it's kind of hard to, if you're not getting the roster and the phone numbers, it's hard for you to kind of know what to do. Okay, but if they want to get a hold of you, you can leave all your marketing out, they can pick it up and go. And they do have auditors that come through, so you can't kind of wink, wink, not get the roster. Okay, so that's kind of important. Properties purchased have to be a primary residence, and they cannot be used in any sort of trade or business. Now we're going to talk about that. The very next line says the maximum lot size is 2 acres, and there are waivers up to 5 acres. So here's where that comes to be important. Virginia Housing wants this house to be your primary home. They don't want you buying a hobby farm. They don't want you buying an investment property that it turns into an investment property. They're not going to do duplexes. They're not going to do triplexes. They're not going to do quads. They're strictly going to be doing owner occupant. They don't want you buying a house that has possibility of being like a hobby farm. So that's why they have the 2 acre maximum is a 2 acre. Now you can get a waiver over 2 acres. But here's what they're going to do with that is in that waiver, they're going to look at the property to make sure that it's not set up as a hobby farm where you can have goats or a barn or chickens or cows or anything like that. They just want to make sure that this is truly set up as, that doesn't mean you can't have a garden in that 5 acres, but what it means is that they don't want you turning it into a horse farm. They don't want it to be something like that. Okay. So that's a pretty big important thing. Maximum debt ratios. Everything that you're seeing here on this eligibility sheet is what's called an overlay, because this is not a requirement of FHA. This is not a requirement of anything but VHDA itself. The maximum debt ratios are very, very, very strict. They're strict at 45%. So that means that if you add up all your income and you add up all your debts and all your new house loan, you put all that together and divide it. If you're over 45% debt ratio, you are no longer buying this house. If you're 45.0001, you're not buying this house. Just simply not buying this house. So you have to maintain the debt ratios well below that mark of 45%. So now I'm going to go to the Virginia website real quick, and I'm going to show you right here what they have as far as the sales income price tags for each one of these spaces right here. So this right here is their current graph on housing. And so you can see on there, this is their income, sales price, loan limits. And right here, this one is as of May of last year. Every year they update it. Oh, sweet. So they don't have that piece right there. It's not on the screen. Oh, there it is. Great.
This one?
It is, but that one's outdated. So I want to share the correct one. The correct one is right here. Maybe.
Something in the corner.
Come on, Joe.
Yeah, Joe can best-
All right, so here it is. It's not Joe's fault, Latasha, it's mine. Let's see here. So now we're gonna go back in and share. And here is a screen for the shared app. All right, so this is the current, maybe. This is, okay, you can now see my application. All right, so this is the screen right here where you can see it's under income and loan sales limits, sales price and sales limits. This one right here is going to give you the maximum for each one of these properties. So you can see that they have it built out based off of what they call area metropolitan statistical areas. And so you can see they've got Washington, Charlottesville, Richmond, et cetera, et cetera. Now we happen to be in the Richmond region. And so we're going to go off in the metropolitan statistical area of Richmond. Now, if you really have if you have a specific area that you want to see down here, you can see how they've divided up these metropolitan statistical areas. And it gives you the counties for each one of these. And the reason why this is important is because you can see some of these counties over here that, like Williamsburg, even though that could technically be part of the Richmond region, they've actually put it in the Norfolk, Virginia Beach region. Now, why is that important? Is because the Norfolk, Virginia Beach region is actually lower than what you're seeing in the Richmond region. Okay, and that's actually pretty important. Now, what you're going to see here with these is this is the one of their overlays right here, which is they have an income cap and a purchase price cap that they're allowing you to do. So over here on this side, you've got the 2 or fewer people, and over on this side, you have 3 or more. So in other words, if there's just one person in the family, or a person and a child, or a person and a spouse, this is what we're going to be looking at as far as income. Whereas if it's a person and a child and grandma, now we're going to be looking at that one. Okay. Now there's a nuanced difference between the standard and with the grant. Okay. And so I want to make sure I make that this clarifying point right here. This one right here is based off of individual income. So that's pretty reasonable, right? In the Richmond area, if you have somebody making $98,400 with this program, they can have a maximum purchase price of $425,000. That's a really reasonable way to go. Now that's based off of individual income. So let's say that me and my wife go in and apply. She makes 150, I make 75. We're not qualifying with her on the loan. Okay, so now it would be just me on the loan. We can buy it that way and we can make that work. Now, where this falls apart is when you get into the distinction of going for the grant. Because when you go in for the grant, it's now based off of everybody who lives in the house, part-time, full-time, Tupperware parties, doesn't matter what you're doing income-wise, every penny gets counted. And so now her 150, my 75, and my kids got a part-time job at Kroger getting 5 hours a week during school. Okay, I have to include all of those incomes. Okay, so the grant is much, much more restrictive. And just remember this, with more money they give you, the more restrictive the program ends up being. Okay, so this is pretty key. Now, here's the great thing about it is now you're dealing with $425,000 purchase price. And in this area that we're in right here, you know, Chesterfield County, Dinwiddie, Goochland, Hanover County, all the way down to Petersburg. Okay, all this stuff, most of what you're going to be working in is going to be in the Richmond region. Okay, so you're going to find that this is a very good way to help get into what you're trying to accomplish. So let's go back into this now, and I'm going to go ahead. Oh, it went right straight back to it. Look at that. All right, so there's that.
What do they consider somebody living in the house? Like if you have a kid in college, where's the qualification for what counts as a person, I guess?
If there's going to be somebody in there who's going to be living there full time, then they would be considered an equal.
So college kids wouldn't count them.
You're right. Okay. All right, so this right here is the down payment assistance grant. And this one right here is going to be is where we get into the grant program itself. So there's two different types of grants that are out there. There is a 2% grant, and then there's a 2.5% grant. And that's really depending on which type of loan you're going to be going for. There's a conventional version, and then there's an FHA version. We've talked about conventional, we've talked about FHA in the past classes that we have. What they're doing is they're also doing FHA or conventional, but they're also ascribing a grant to it. In the past, 3 years ago, all they had was FHA. And so this is actually a pretty cool thing that they've added to it. So people with decent credit can come in, buy a house, get a 2% grant that they don't ever have to repay. And that helps them buy this house instead of handcuffing them with the FHA style structure. Now the FHA, they're going to give you a slightly higher grant, it's a 2.5% grant, but you have to refinance in order to get out of that mortgage insurance at some point in time. Now the minimum credit score that they have is a 620, and that is a physical hard stop. If they're at a 619, they are not buying this house with that type of loan. They're just not buying it. Okay, so that has to get changed up. The maximum debt ratio is 45%, and it's extremely restrictive to that. Now you can't, the grant funds, you cannot use in conjunction or in combination. In other words, you can't piggyback them with other types of grants. Okay. Now they have changed this recently to where you can do that, but I'm going to tell you that it's very difficult to get a multiple grant situation through. Okay, it's just very difficult. And here's what I mean by that is when you're getting multiple grants, you are now looked at with an additional layer of risk, because they're looking at it from the standpoint of why do you need so many grants? And so it's not that you can't do it. I'm just going to tell you that it's very difficult to get one of those through. Okay, down payment assistance grant, you do not have to repay, which is kind of nice. And you can also receive the mortgage credit certificate through this. Now, the mortgage credit certificate, I think we have another slide later on that talks about this, but I'm going to just dive into it real quick. Mortgage credit certificate, what that is it's actually a great benefit for the buyer, especially if they can get it under the conventional loan. It doesn't cost them any money if they do it through VHDA. If they do it outside of VHDA, because they can do that as well, there is a cost of $750 to apply for it, but under VHDA, there is no application fee for it. Now, having said that, what it does with the mortgage credit certificate is it is a credit towards your federal and state taxes. And so what that does is you have to take it to a CPA in order to do this. You can't just do this on TurboTax anymore if you're going to do it. But in essence, it can provide you with up to a 30% savings on your tax bill if you have the MCC credit. Now, if you're not paying any taxes, you're not going to get more blood out of that turnip. But if you're paying taxes in, then in essence, you're going to get some of that back.
Is that just like a one-time thing?
No, it's annual. Yeah, it's as long as you either own the home or you keep the VHDA mortgage on the home. The minute you refinance it or you sell the house, you lose it. So this is where if you're using it with an FHA style loan, you end up losing it when you refinance, because that's what we're encouraging you to do with that. Okay. Government loans, they do have a full range of government loans, whether it's FHA, Veterans Administration, or rural housing or USDA loans. You can get the 3.5% down or the 0% financing with each one of these. They do have maximum loan limits for those based off of the sales price and also off the qualifying area. Those numbers are usually reduced compared to what the standards are for each one of the. The FHA Plus loan, that's the one I was referring to earlier, which is the down payment assistance loan or the 100% financing. That one there is extremely nice. It's very nice. If they have a credit score over a 680, you can actually finance 1.5% of their closing costs, which is a huge deal.
So this is, because, all right, so this is like who finances other kinds of loans. I'm kind of confused because it says offers loans under government programs such as like VA.
Right, they have VA, VHDA, and FHA as well for just standard loans. In other words, they don't just do the down payment assistance programs, they'll do the regular loans as well. Okay, and many times what happens is the Virginia housing will go into areas where there are no banks. So like the Eastern Shore, a lot of times they'll go out into the Eastern Shore and they'll have camps there where they'll actually go out into the community and allow people to get their loans directly from them. Okay, and so you can get a VA, FHA, or USDA directly from them. We can do them too, but I got to tell you that the interest rates for a VHDA loan are so much higher, whether it's VA, conventional, any of them, they're higher than what's happening in the market. So most of the time, if they qualify for one of those, we're not going to steer them into one of those through VHDA. We're going to actually take them into the actual program.
So this isn't a type of loan, it's a financer for different types of loans.
Right.
Okay.
VHDA actually funds the loan. We would call them an investor.
Okay.
And so they're investing in the future of this person who's buying the house by funding the house and funding the mortgage on that house. Okay, so when we do the loan, we're selling it to VHDA based off of the conditions that happen here. So you can go directly to VHDA to do the loan if you wanted to, but most of the banks in the area, including us correspondents, we have access to that and we can do all of this stuff without having to go there.
So someone would pick this loan if they didn't have a lot of money, they were interested in that mortgage certificate, I don't know.
MCC credit.
Yeah. And they maybe didn't have enough money for closing, right? Because you could go back and finance 1.5%.
If they have over a 680 credit score. Okay. Now with the types of loans that they have, you know, regardless of which loan type you're going into, this is an overlay as well. You have to have a minimum of 1% of your own money.
Even if it's a VA loan?
It doesn't matter.
Oh.
You have to have 1% of your own money. Now, 1% of your own money, what that means is on a $200,000 home, you have to have a minimum of $2,000 in the bank. You don't always have to use the money, but you have to show this is an overlay. Once again, this is something that they're requiring. It's not a requirement from Department of Veterans Affairs. It's not a requirement from FHA. Is they want to make sure that the borrowers after closing have the ability to keep the lights on, to feed themselves, to get gas in the car, to do other things like that. Now that's with the down payment assistance programs. With the grant, they actually have to put that 1% into the loan. And so each one of these is slightly different based off of how that works. They only work in 30-year fixed rates. And once again, minimum is a 45% debt ratio. Now they do have what is called a non-traditional credit version. And I have done a non-traditional credit version before with VHDA. I'm going to tell you they're very complex. Non-traditional credit, what that means is we pull their credit report and they literally don't have a credit number. They don't have a credit number at all. Can I help them? Yes, but I have to find 3 to 4 sources of non-traditional credit for me to be able to, in essence, establish their ability to repay. So I can use a cell phone bill, not a prepaid, but a contract one. I can use a gym membership. I can use Netflix. I can use car insurance. I can use rent. In fact, rent is expected if you're going non-traditional. And so here's where this falls apart. If they've not been in the apartment that they're currently in for 12 months, they're not buying until they get that. Okay. If they've just recently changed homeowners insurance or car insurance, they're not getting that either. You see what I'm saying? So there's stuff there that with non-traditional, they compress how much it is that they're willing to let you go with. Okay. Doesn't mean you can't do it, but it does mean it's very, very, very difficult. Okay. Fannie Mae reduced mortgage insurance. This is their conventional version. This is actually a tremendous way to go. If I can get a person with a credit score into, here it says minimum of 640, but I'm going to tell you that you're not getting a very good deal at 640. You'd be better off at like a 700 or 710 or somewhere above 700 to try to go this way, unless you're trying to get around very specific conditions. Here's what I mean by that. This is a conventional loan that we can do where they have a modified mortgage insurance that goes with the loan. It's phenomenal. You can still get the mortgage credit certificate. It is a conventional loan. It has a lower mortgage insurance rate because it's subsidized through housing through Virginia Housing. And so it's a tremendous way to help them. They have higher credit income requirements on these. And so this is going to lower where they can go with this. They can go up to 105% loan to value to get community seconds. And so that's actually not a bad thing. It really does work. It's a great conventional loan to go with. I use it quite a bit on the conventional side. Now, the ratios for the mortgage insurance now, they have two versions of it now. They have a regular version and then they have a reduced mortgage insurance version like the one we're talking about right here. The reduced mortgage insurance version, they've compressed the amount of money you can make on that. So it's not by standard ratios on that. Okay. They now have what they call an 80% of area metropolitan income. And that is really what they look at when they're doing with the reduced mortgage insurance. Whereas if you're making over that 80%, you can still qualify for a VHDA loan, but the mortgage insurance is higher. Okay. They also do have a no mortgage insurance option, which I'm going to tell you is not necessarily a bad way to go, but I am going to tell you that it's a much more expensive way to go. So if you look at the handout or the sheet that you see right there on the screen, you can see that with an FHA, if the rate was 3.875, the rate for the no mortgage insurance is 5%. So while there is theoretically, in quotes, no mortgage insurance, the truth is you're paying for it in the rate. Now, many times I have actually seen this version come out with a much lower monthly payment and help people qualify than the other way. But I want to make sure that when I'm talking to them about it, I'm explaining to them that this is a short-term help to get them into the house, because that 5% never goes away interest-wise. It may reduce their monthly payment. It may get them where they want to go, but it's a very expensive option for them. Okay. Here's a little bit more about the mortgage credit certificate. Is unlike the income tax deduction, the MCC is a dollar for dollar credit against your federal income tax liability. And so you can see there it talks about it being about 20%. It's a phenomenal way. If they're doing VHDA, most of the time we try to sign them up for this to see if they can take it. And if they can, then we certainly help them do it. If they are doing this through a non-VHDA source, you can see down there that there is a $750 charge to do that MCC. Areas of economic opportunity. So when you get to the point to where you're looking and you have a first-time home buyer a second-time home buyer who wants to buy a house, but they don't have a ton of money, this is where you get into going to their website and plugging their website in to see if they're in an area of economic opportunity. And if they are in an area of economic opportunity, it's a good chance that you could actually help them get this house with 100% financing or a grant of something or something of that nature, and make that work from there. Okay. And moving to the next slide, the recapture tax. Now, this is where all this stuff, you need to be very aware of how VHDA does work. It's a tremendous program for you, but they do have what's called a recapture tax. What that means to you is this, is if you're getting into this, and let's say you're a doctor in residency. In other words, you're not making a whole lot of money right now, but in about 2 years after you get out of residency, you're just going to be slaying it because you're going to be doing surgical procedures on people, and your income is going to go from a resident, which is like $60,000, to a full doctor, which is going to be like $300,000 to $400,000. Okay. Well, when you decide to sell this property, if you decide to sell this property, you've lived in this property for 2 years. Now what ends up happening is you are in that window of time where they can ask for a recapture tax. What that means to them is this: when you're going into buying a home with a first-time home buyer loan, you are committing to that property for a minimum of 5 years.
For any loan or just this?
VHDA.
Okay.
Any of the VHDA loans, you are committing to it for 5 years. During those first 5 years, you are at the maximum of they call it a recapture tax, but in essence, what's happening is you're paying back the grant, or you're paying back part of the subsidy that they gave you because you sold that property within a period of time and your income has gone up. There's a very complex chart that they have that they refer back to, and they tell you to look at to try to calculate this recapture tax. In essence, what it is if you were to go ahead and sell this home within the first 5 years, what ends up happening is you have to pay back that tax. And in essence, you're splitting the proceeds from the sale of the home with the HDA. So in other words, let's say in 2 years, the home value bought it at 200 and now it's worth 250, and you're going to net $50,000 off this. You have a liability back to them because you've changed your job, your income's gone way up, the value of the property's gone way up, you've sold it within the first 5 years. That $50,000, a good chunk of that is going to go back to VHDA. That's just the way it works.
But that's only if you sell it.
That's only if you sell it.
Can you get a loan and really live in the house and not defraud the government? And then, well, I'm just, and then decide, hey, you know what, I'm gonna go buy this other house, keep this one as an investment, and then still.
Yes, the answer is yes. There's a lot of people that do that.
Okay.
And a lot of people, what they do is they turn around, and after living in the property a period of time, usually 24 months, they can turn around. Now, Freddie Mac, Fannie Mae only require 1 year. And that's really what VHDA says too, that you have to own or occupy for 1 year.
Mhm.
But if you sell it anytime before that 5-year period, then now you're liable for it. But if you keep it and convert it to a rental or something like that, refinancing doesn't even help. Because if you refinance out of it, that VHDA thing is attached to it for the first 5 years. So refinancing doesn't even eliminate it. Okay, they watch it for the first 5 years. There's a recapture tax if you do it in that time. Otherwise, if you wait until after the 5-year time frame, they still have the opportunity all the way up to 10 years to ask for a portion, but it's prorated after year 5. Okay, so when you're going into this, you need to talk to people about this. What is your strategy with this house? Well, I'm planning on being here 3 years. Okay, this is maybe not the best vehicle for you to buy this house, because the recapture tax could possibly end up costing you more than it's worth when it's said and done. Okay. All right, credit guidelines. I mean, they have a lot of overlays, but the biggest one is a 620 credit score. They just simply are not going to let you go down below that. They are going to be looking at the 3-year history to look for bankruptcies, foreclosures, etc. They can't have any. So when you have a significant credit event, meaning a bankruptcy or foreclosure, their way of looking at it is very different than through agency guidelines or FHA and the other Fannie Mae, Freddie Mac. With Fannie Mae, Freddie Mac, if you lose a home, you can get an FHA loan within 3 years. But with VHDA, if you've lost a home, you're waiting 5 years. Okay, you're just simply not using the VHDA loan until after 5 years. Now, that is a very specific requirement just for VHDA, and you need to look very carefully and ask those questions, especially if you look at the credit report, you see that they've had something in that period of time. Okay. Property guidelines, condominiums, It has to be in Virginia, obviously. They'll do townhomes, condos, and single families, but notice that they say eligible condos because they're very restrictive on their condo. They will not do anything over a single unit. So if you're looking for a duplex or a triplex, they're just simply not going to do it. Okay. And the land must have a maximum of 2 acres. Once again, residents have to be, if you have additional living space in there, which would be used for investment, they're not going to take it. In other words, if it has an in-law suite that's fully built out, they're not going to take it. They're just not going to take it. So you have to go with a different type of loan. You can't finance any personal property. What that means is like lawnmowers, yard patio furniture, stuff like that. But that's every loan's like that. Okay. Unfinished area. Okay. Yeah, you can't, if you were to finish off that additional area, it can't exceed the maximum sales price. And so that's kind of one of the big things there too. Other than that, they really do follow industry guidelines. Now, if we're going to do a manufactured home or a mobile home, this is the one place, the only real investor that we have for mobile homes. Okay, you can do it. We do have one other source, but I'm going to tell you it is so painfully expensive that in most cases it's not worth the time. But this one right here is probably, if you're going to do a mobile home, we would end up doing it with VHDA. Okay. Well, that's pretty much it with, and it looks like we lost Latasha. Is it Lashana or Latasha? Okay, we lost her. But anyway, any questions or thoughts as we go through this? And, VHDA? Nothing? So either I did a great job or terrible job. So there we go.
So
All
if
right.
we have a client and we say, hey, go talk to Joe or Chris, you present all these, you run all the options for them, or?
Yeah, we tried to.
To try to.
Yeah, I'm working on one right now with VHDA, and they qualify me, credit score right over 620.
Mhm.
And we're able to get him the other issue. There's some other things, like for example, this one, we need to make sure he needs to get a gift because he doesn't have enough money to pay for closing costs.
Are gifts okay? I saw something about.
Yeah.
I didn't read it.
Yeah, you can do gifts, you can do other things like that too, but it certainly is, VHDA is trickier, but when they come in as first-time home buyers, we try to look at the options.
Yeah.
We generally try, if they have the money, we generally try to give them the option of doing a down payment loan because it's much easier for them, it's much better for them long-term, but many of them are not interested in that kind of stuff, if they're trying to save some money. So, okay. All right, well, I'm gonna go ahead and stop the recording for now.